the 10-year bond yield have taken a big spike, and that's why you're looking at the lowest point of the Nifty right now. So the 10-year 2023 bond actually hit 9% mark. And to discuss this and the repercussions it could have on the portfolios of several banks in the sector, we have Mr. Arun Kaul joining in from UCO Bank. Mr. Kaul, the bond yields just don't seem to be easing out. In fact, a multi-year high or 5-year high being hit just moments back. What kind of impact are you penciling in for your balance sheet or because of this phenomena?
You see, we do see bond yields moving up because of the rupee weakness, liquidity being sucked out by RBI, and also with the cash management bills. Short yield curve has moved up, and on top of that, the panic because the oil is at $110 per barrel and US Treasury bills are moving up. Now, all that is slightly unnerved the market and the yields have gone up. There is supply side also very strong. Every week there's supplies coming up. Central government, the state government borrowings are coming up. So that's putting pressure on the market. At these levels, yes, will certainly adversely hit the banks. The AFS portfolio, there will be very large depreciation. And there's a worry on the part of the banks.
Mr. Kaul, afternoon, 9.02 now for the 10-year bond yields. And at this rate, if this kind of movement continues for a few more weeks, are you of the view that bankers will have no option other than to just hike deposit rates, and eventually they'd have to hike the base rates in order to protect their margins?
You see, so far the increase in the GSEC yield is concerned will adversely hit the portfolios. There'll be MTM losses on the AFS portfolio. Now, coming to base rate would depend on the cost of deposit. I quite agree, shorter end of the yield curve has moved up. Short-term money has become scarce and costly. Now, if the cost of fund moves up, because banks' entire resources are not short-term. We have short-term, medium, and long-term funds. If cost of fund moves up, banks have no option but to passing the burden to consumers.
Right. Sir, are you expecting that in the system, the rates would actually start moving up now that we are at 9% plus?
We have seen some short-term yield rates moving up. We have seen 3 years, 6 months, 3 months, 6 months, and 1 year rates moving up.
Also, sir, you did not indicate about your own bond book because of this hike. Surely point taken that only the long duration bond, the yield is, at 9%. But on average, what kind of impact are you looking at your own bond book?
No, we are in the process of assessing the impact of the market on the bond portfolio. Yes, there would be some MTM losses. MTM losses would be there.
Put a number to it, Mr. Kaul?
We are in the process of working it out.
Fair enough. In terms of any regulatory changes on the overall for the banking sector, is there anything that you're expecting from the Reserve Bank in order to help protect the profitability of banks?
I'm not aware about any such move at the moment.
No, sir. Is there anything that you would expect from the Reserve Bank?
Well, I think RBI, in the last credit policy meeting, banks did request RBI to consider various measures, including permitting one-time shifting of security to held to maturity. But I'm not sure what's happening on that.
Right. Sir, but we understand that bankers had earlier requested for some relaxations from the RBI front, at least to the norms or how NPAs are calculated, at least their accounting profit could be protected. Are you expecting some progress on that?
No, like I said, I have no idea about this. I have absolutely no idea.
So, but the way rupee weakness is not being stemmed despite measures, and the bond market too seem to be ignoring the measures which have been taken by the government and RBI. What is, in your mind, logical thing to do from the RBI's front? Because I'm sure they wouldn't be just waiting and looking at the way macro indicators are spiking either side. Are you expecting to hear from them or some measure in some form shortly?
You see, in the past, whenever there was pressure on the currency, RBI did hike the shorten the yield curve. They also sucked up the liquidity, and that impacted into speculative pressure being taken off on the currency. That means that time there was speculative pressure which was taken off, and we did notice, stability of the currency. Currently, whatever steps RBI has taken has not held the market at all. We have not seen currency getting stabilized at all. They're still very volatile. Probably speculative pressure is not very high. It is more fundamental problem. Probably our imports are much higher than exports. More corrections are required out there.
Yeah, it certainly is exceedingly volatile as we speak, even hit a level of 62.62 against the US dollar. But Mr. Kaul, with respect to what the Reserve Bank is likely to dole out, given that they have been fairly hawkish in their previous monetary policy stance and the commentary has also remained focused on the currency, is there anything that you're expecting in terms of repo or CRR cuts?
No, I think if the RBI has a view that there is a speculative pressure in the currency, the attempt on their part would be suck out the liquidity and push up the short in the yield curve. This is what they did in the last couple of moves, and I have not seen any major impact on the currency. So that means they'll have to look at very carefully what the reasons for currency volatility and take steps if it is their approach.
On account of the way the yields are moving, do you think that bankers are now in the need for more capital? Do you think that the government will be able to meet the capital needs now for the bankers?
No, let's wait for the 30th September figures.
Mr. Kaul, what's your view on the auction which has happened today? Now the range we are talking about for the short-term auctions is 12 to 12.25, and even the yield curve has got inverted. How do you read this?
No, you see, whenever there is, like I said earlier, pressure on the currency, yield curve will certainly get inverted because the attempt would be to push up, shorten the yield curve so the speculative pressure can be taken off, and that's precisely what it's happening. So if RBI feels that the speculative pressure, they'll certainly take these steps to take speculative pressure off.
But you wouldn't read it as
the liquidity is very tight. There's undoubtedly market liquidity is very, very tight, and short end has moved up.
Mr. Kaul, from an overall macro perspective, what do you think is the reason that we are seeing these kind of levels on the bond yields? Do you think it is because of the auction of the cash management bill as liquidity continues to remain getting squeezed out of the system?
No, like I said, there are a couple of reasons for the bond yield for having moved up. Number one, the rupee is depreciating. Number two, liquidity has been sucked out by RBI. Number three, RBI actions have pushed up the shorter end of the yield curve. Oil continues to be very high, putting pressure on India's trade deficit. U.S. Treasury yields have moved up. Thereby, expectations are that across the world, interest rates are likely to move up. So all those factors have contributed to bonds moving up.
So one final question before we let you go. Do you expect some easing to happen during the day today?
I'm not very sure. Since morning, the way we have seen, I'm not very sure that there will be easing to take place by evening.